Okay, you might be asking what the hell happened on Monday that caused the Japanese markets to halt, finish 10% lower, and US stocks on the Nasdaq at one point to be down more than 5%. This was most likely due to the carry trade of the yen and the dollar. So, what is the carry trade? In the carry trade, you borrow in a currency that has a low interest rate and use that cheap financing to buy other investments. So, for decades, Japan has had 0% interest rates. What has been the constant case right now is yen weakness and US dollar strength relative to the yen. So you borrow in very cheap Japanese currency and you go to the US money market and you do an arbitrage of interest rates because you can get about 5% interest rates right now in the US, and while Japan is basically at near zero. You can also use that cheap interest rate to buy US stocks, and those tend to go higher with a lower yen. The other side of the trade is what happened recently. So last week, the Japanese central bank chose to raise rates unexpectedly. So now you convert your yen to dollars, you have to pay back in more dollars as the yen strengthens relative to the dollar. On top of that, your investments in bonds yield less and your US stocks go down. So you get margin called and you have to force sell your tech stocks, and you have to close the position by buying yen, which further strengthens the yen and weakens the dollar. So there are a few Japanese stocks to watch that could be affected by what's going on recently, because this is a multi-$100 billion trade that essentially is being unwound right now. So the Japanese banks that you want to watch would be SMFG, MUFG, and SFTBY. So that's SoftBank, Mitsubishi, and then Sumitomo. Those are a few. There's likely to be others, but those are the main ones you might want to be watching right now. So a lot of people are also blaming the sell-off on ISM manufacturing data, and while that did contribute, the yen was also very strong before that was happening. That was basically the cherry on top. So in a nutshell, basically, we got a stronger yen, a weaker dollar, higher rates in Japan than expected, lower relative rates in the US, and we have lower stock prices in the US recently very, very fast. So you get margin called and you lose on both sides, on the borrow of the yen and on the investment you made on the yen, because your investment is lower than when you bought it, and you need more yen to pay back from your initial borrow. So really quickly, why are emergency rate cuts bearish? Well, the thought is that lower interest rates will stimulate the economy. This does happen eventually. In the short run, let's say about 6 months or so, it implies that the Federal Reserve cannot wait until their next scheduled meeting to do an action regarding monetary policy. So that means that essentially there's some sort of impending doom scenario that needs to be corrected right away. And markets often sell when things are either unknown or there's bad news to be anticipated. So the last example of this was COVID, where interest rates immediately went to zero and there was a wicked sell-off that day. So if you have any questions, feel free to DM or send a comment. Thanks. Okay, so now it is Tuesday, August 7th, and there's actually been a development overnight. The BOJ basically just said it's resuming its policy of easing after the Japanese markets threw a temper tantrum on Monday. They essentially said that there's going to be no more rate hikes, and I'm quoting the bank directly. We need to maintain monetary easing with the current policy interest rate, with developments in the financial markets being extremely volatile. Hence why Japanese stocks are up in excess of 5%, and the US markets are up about 2%. This basically bails out a lot of people who were short yen, as it immediately lost 2% of its value relative to the US dollar in about 2 hours. This reinforces the belief that the BOJ has lost its teeth and will buckle at the first sight of market struggles.